It was supposed to be the breakout. Silver was flying. Charts were clean. Confidence was loud. And then, without warning, the floor disappeared. One moment, silver was marching toward $64. The next, it collapsed. Not slowly. Politely, it snapped. Red candles, one after another. Stops triggering. Counts liquidating. Billions erased in minutes, and across the world, the same reaction echoed in real time. What just happened? Is silver dead? I thought this was the safe trade. This wasn't a normal pullback. It felt violent, calculated, personal, retail. Investors, people who had waited years for this moment, were caught completely off guard. Some froze, some panic sold the bottom, some just stared at their screens, heart racing, watching months. Sometimes years of conviction vanish in seconds. Because this wasn't just money on the line, it was trust. Trust in the thesis. Trust in the timing. Trust in silver itself. And the headlines wasted no time. Silver rally fails. $64 rejected. Bubble pops. Silver is over. 3 words that hit harder than the crash itself. For a brief moment, it felt final. The market had spoken. Like silver had made its move on, failed. But here's the part no one talks about in the chaos. Markets don't usually destroy confidence by accident, because when something collapses this fast, it's cleanly at a level everyone was watching. You have to ask a dangerous question: who's on the other side of that trade? Think about it. The $64 level wasn't random. It was obvious. Too obvious. Every YouTube chart, every Twitter analyst, every Telegram group. Once silver clears $64, it's gone. Next stop. All-time highs. No resistance above. And markets have a cruel habit of punishing certainty. When everyone leans the same way, the market doesn't reward them. It resets them. And that reset feels exactly like what happened next. The speed, the precision, timing. This didn't feel like silver getting weaker. It felt like people getting shaken. Here's what made this crash different. There was no major news. No sudden change in fundamentals. No overnight shift in global demand. Just fear. Pure, raw fear. And fear is the most effective tool in the market, because fear forces decisions. Bad ones. Now, quick note, this isn't financial advice. This is market behavior analysis. Understanding psychology is not about predicting prices. It's about recognizing patterns. And the pattern here was clear. Retail sold in panic, while someone else stayed calm, because while social media was screaming, something quieter was happening beneath the surface. Volume surged. Volatility spiked. And price stabilized faster than anyone expected. That's not how dead markets behave. That's how traps close. So now we're left with a question that refuses to go away. Was this really a failure, or was it a test? Because if this was just a crash, the story would already be over. But it was in what if the $64 collapse wasn't the end of the silver story? What if it was the moment the wrong players were forced out? Because next, we need to talk about why that price level mattered so much and how obvious resistance becomes the perfect weapon. $60-$4, say it out loud. It sounds important because it is markets don't move on numbers, they move on beliefs. $64 had become a belief, not just a price, but a promise. Everywhere you looked, the story was the same. Once silver breaks 64, above this level, there's nothing stopping it. This is the last wall. And that's exactly the problem. Because when too many people agree on the same outcome, the market stops rewarding. Logic hand starts testing conviction. This is where psychology takes over. Retail traders don't place trades randomly. They cluster, they buy breakouts, place stop losses at obvious levels, protect themselves where everyone else does. And $64 became the most crowded idea in the silver market, a magnet for hope and a perfect target. Here's the uncomfortable truth. Obvious resistance doesn't just block price, it attracts attention, and attention is information. Big players don't guess where liquidity is. They know. They know where fear lives. They know where stops sit. They know exactly how much pressure it takes to force a reaction. So when silver surged toward $64, it wasn't just price action, it was a signal flare. Think of it like this. If you wanted to exit a massive position or enter one quietly, where would you do it? In silence, right where everyone is watching. That level, the one retail thought was safety, became the perfect leverage point. Push price just far enough, trigger the stops, let panic do the rest, and when the selling starts, it feeds on itself. Stops become market orders. Market orders become momentum. Momentum becomes fear, and fear doesn't ask questions. This is why markets punish certainty, because certainty removes flexibility. It replaces risk management with belief, and belief is fragile. The crash at $64 wasn't random. It was mechanical, predictable, in fact. It followed a script that's been used for decades, not just in silver. Gold. In stocks. In crypto, everywhere liquidity hides behind confidence, and that's where the tension deepens, because this exact structure, obvious level, crowded positioning, violent rejection has shown up before, right before some of the most explosive moves in market history. So now the question isn't whether this was a trap, it's whether we've seen this trap before, and what happened after it snapped shut. Because the last time silver did this, the aftermath rewrote the entire narrative. And that's where history starts whispering. History doesn't repeat itself, but in markets, it rhymes. If the $64 crash felt strangely familiar, there's a reason for that, because silver has played this game before, more than once, and every time. Story starts the same way. Confidence, momentum, crowds piling in, then sudden collapse. Go. Back in time, before silver's last major run, there was a drop so violent it convinced investors the rally was dead. Charts broke. Media turned hostile. Commentators called it the end. Sound familiar? That crash didn't come at random, came at a level everyone trusted, and just like now, that trust became the weapon. Weak hands were shaken. Out every violent move in the market leaves wreckage, but it also leaves footprints, because here's the rule no one likes to admit. Markets don't crash equally. Someone always wins. While retail investors were panicking, refreshing charts, closing positions, second-guessing everything, someone else was doing the opposite. They were calm, patient, ready. Look closely at what happens during sharp drops. Price collapses, but volume explodes. That's not absence, it's activity. And activity tells a story most people never read. If everyone was selling, who was buying? Because markets can't move without a counterparty. Every panic sale needs a calm buyer, and calm buyers don't show up by accident. This is where institutional behavior separates from retail emotion. Large players don't chase breakouts. They don't panic on headlines. They wait for stress. Stress creates liquidity. Liquidity creates opportunity. Fear is loud, but it's also cheap. Think about it. If you wanted to build a massive position in silver, would you do it while price is screaming higher and attention is everywhere? Or would you do it when confidence collapses, when sellers are desperate, and headlines do the dirty work for you? This is why crashes feel cruel, because they transfer assets from emotional hands to disciplined ones, and the clues were there hidden in plain sight. Despite the chaos, silver didn't free fall indefinitely. It stabilized. It absorbed selling. It held structure better than fear suggested it should. That's not weakness. That's absorption. In market language, that's someone stepping in, quietly, relentlessly, not posting tweets. It's not ringing bells. Just executing a plan that depends on one thing: other people panicking. And here's the uncomfortable part. This doesn't require conspiracy theories. It doesn't require secret rooms or hidden levers. It only requires understanding human behavior. Fear compresses decision-making. Fear speeds up mistakes. Fear hands control to those who prepared before the drop, and preparation always happens in silence. Again, this isn't a claim of guaranteed outcomes. It's an observation of how liquidity and psychology interact during volatile markets. Now here's where this story gets unsettling. Because the same players who thrive during crashes don't watch headlines, they watch signals. Signals that don't care about emotions. Signals that don't trend on social media. And one of those signals, the kind that only appears after shakeouts. It's like this. Just flashed again. Almost no one noticed it. Almost no one was looking. But the last time this signal appeared, it changed everything for silver. And in the next section, we're going to talk about what that signal is, and why missing it could mean misunderstanding this entire crash. While everyone was watching the crash, the market was whispering. This is the part of the story most people never hear, because fear is loud and signals are quiet. As silver collapsed, headlines screamed panic. Social feeds flooded with predictions of doom. Confidence evaporated, and that noise did exactly what it always does. It distracted everyone, because buried underneath the chaos, beneath the red candles and emotional selling, a rare signal appeared. Not flashy, it's not viral, it's powerful. The kind of signal that doesn't show up often. The kind that only appears after fear has done its job. Let's simplify this. Markets move in cycles. Expansion, excess, panic, reset. Most people only react to price. Professionals watch conditions. And right after the $64 crash, those conditions aligned, volatility spiked to extremes. Selling pressure surged, then slowed. Volume stayed elevated. Even as price stopped falling. That combination is rare. It means something critical. It means sellers are running out. Buyers are no longer afraid. This is why retail missed it, because fear narrows vision. When people are scared, they don't analyze. They react. They don't ask who's buying right now. They ask, how do I make the pain stop? And that's exactly when signals matter most. Here's the eerie part. This same setup, the same compression, the same volatility spike, same post-crash stabilization has appeared before. Not many times, but when it does, silver doesn't move quietly. It pauses. It frustrates. It lets doubt settle in. Then it reprices violently, not gradually, not politely. Explosively crash first. Silence next. Expansion last. Crash. Silence. Expansion. That's the rhythm, and the numbers tell the same story. After similar signals in the past, silver didn't gain a few percent. It doubled, tripled, sometimes faster than anyone expected. By the time the crowd realized what was happening, the move was already gone. But here's the twist. Signals don't mean timing is immediate. They mean conditions are set. Which brings us to the most dangerous part of this entire story. Because if the signal has already appeared, and the breakout hasn't happened yet, then what are we waiting for? The answer isn't price. It's patience. And that's where most people fail. Because next, we need to talk about why the real breakout hasn't happened yet. Why silence is part of the strategy. And how markets use boredom the same way they use fear. And if you don't understand that phase, you risk walking away right before everything changes. If this was the real breakout, why does everything feel so quiet? This is the phase that confuses people the most, not the crash, not the rally, the waiting. After the $64 collapse, fear did its damage. Weak hands exited, emotions burned out, and then something unsettling happened. Nothing. No fireworks, no instant recovery, no dramatic follow dash through, just sideways movement, small candles, boring price action. And boredom is dangerous, because boredom convinces people the story is over. Here's the reality. Markets don't only manipulate price, they manipulate time. Price manipulation creates panic. Time manipulation creates doubt, and doubt is more effective. Think about it. After a violent shakeout, most people expect one of two things: a fast bounce or total collapse. When neither happens, confidence erodes. People get tired. They move on. They stop paying attention. That's not an accident. This consolidation phase is where positioning happens. Big players already used fear to clear the field. Now they use time to make sure no one comes back too early. Because if price explodes, immediately, it invites competition. If it stays quiet, it invites indifference. And indifference is the cleanest. It's environment for expansion. This is why silence matters. It hides accumulation. It lowers expectations. It drains emotion from the market. By the time movement returns, most people are psychologically unprepared. They sold lower. They hesitated higher. They watched from the sidelines. This is the transition. Fear fades first, then boredom, then disbelief. Only after disbelief does expansion begin. Fear shakes you out. Boredom keeps you out. Breakouts happen without you. That's the sequence. So when people ask if silver is so strong, why hasn't it moved yet? They're asking the wrong question. The better question is, how many people are still watching? Because markets don't explode when attention is high. They explode when attention is gone. And that brings us to the final, most important part of this story. Because now the trap has already been set once. The real danger is falling for it again. So what happens next? And more importantly, how do you avoid being shaken out twice? The crash wasn't the end. It was a test. A lesson disguised as chaos. Millions ran. They sold in fear. They closed accounts. They let emotion dictate their decisions. But here's the twist. While most were fleeing, a small few were learning. Because every trap has a mirror. Every panic has a hidden opportunity. The difference between regret and reward isn't luck. It's awareness. It's understanding the game before the game plays you. Let's take the $64 crash as an example. Lesson 1. Obvious levels can be weapons. Those who panicked saw loss. Those who stayed calm saw positioning. Lesson 2. Big players don't react emotionally. They position. They buy when fear is high. They pause when boredom sets in. They exit only when the move is clear. Lesson 3. Markets reward patience and understanding over impulse. Regret comes from reacting. Reward comes from observing. If you want to navigate silver or any market, you have to think like them, not like the crowd. It's not like the headlines, not like your fears. Think like the players who plan, anticipate, and move quietly while the world panics, and risk awareness is key. Opportunities don't ignore danger. They embrace it carefully. Big moves happen fast, and emotional traders get left behind. So understanding timing, psychology, and positioning isn't optional. It's survival. The $64 trap proved one thing. Fear clears the path. Boredom sets the stage. And patience wins the game. So remember, the crash wasn't just destruction. It was a lesson, a setup, a warning. And when silver finally moves, it won't wait for permission. It won't wait for headlines. It won't wait for consensus. It will explode whether you're ready or not. The question isn't if the breakout will come. It's if you're ready to see a tanned act before the crowd realizes it's already happened.